This isn't a story about deciding to start investing. You already do that. This is about the decision you make after you're already doing it right. You've been putting $500 a month into an index fund long enough that it stopped feeling like a sacrifice and started feeling like a bill you pay yourself. Then, one Tuesday, your paycheck changes. Not life-changing, just enough. An extra $500 a month that didn't exist in your budget last week. Everyone around you has an opinion before you even ask.
A friend mentions a nicer apartment. Another says you've earned a better car. Nobody suggests doing nothing with it, because doing nothing with new money doesn't occur to most people as an option worth mentioning. You sit with it for one evening, and instead of upgrading your life, you double the transfer. $500 becomes $1,000. Same account, same fund, same automatic schedule you set up years ago. You didn't start something new. You just told the old system to work twice as hard.
And here's what surprised you. It didn't feel like doubling anything. It felt like adjusting one number in a settings page. Within a few days, the new $500 was just as invisible as the first one always was. Year one, the account holds a little over $12,000. You put in $12,000 yourself. The market added a few hundred on top. Unremarkable, but you already know what year one is actually for. It's not the growth. It's proving to yourself that doubling the contribution didn't double the sacrifice.
It didn't. Your spending at the end of the year looks almost identical to before the raise. The extra money came out of a few forgettable dinners and a subscription nobody remembers signing up for. A coworker who's been investing the same $500 a month notices your bump and says she's been meaning to do the same. You don't push her. You've learned that telling someone to start earlier rarely moves anyone faster than their own timing does. Fast forward to year 10. The balance sits around $174,000.
This is the year the math flips. At this size, growing near 7% a year, the account generates a little over $12,000 in a strong year, roughly what you're contributing annually yourself. For the first time, the money already inside the account is producing more than the money you're adding to it. And here's the twist. If you'd stayed at the original $500 instead of doubling it, this crossover would have taken 2 years longer. Run the counterfactual, and the account would be worth less than half of what it is now.
The extra $500 didn't just add money, it pulled the entire timeline forward. By year 20, the balance crosses over $520,000. You've contributed $240,000 total. Compounding added slightly more than that on its own. The account now generates over $36,000 in an average year without you lifting a finger. Your coworker left the company years ago. You never found out if she ever doubled hers, or whether that raise quietly became a car payment instead. You think about her more than you'd expect, usually right when a number like this crosses a threshold. By year 30, the account crosses $1.2 million. You put in $360,000 of your own money across 3 decades. The market contributed the other $860,000 you never worked an extra hour to earn. Now isolate just the second $500, the part you added after the raise, and look at what it built entirely on its own, nearly $70,000. More than half of that difference came from that one decision, made in about 4 seconds on an ordinary Tuesday, simply by noticing a raise before you spent it. Somewhere tonight, someone is investing $500
A month, exactly the way you used to. They just got a raise. It's sitting there right now, unclaimed, not yet spoken for by rent or a car payment that would feel completely reasonable because it is. They don't know yet that the thinking isn't the hard part. The hard part is closing the laptop before the feeling passes, before the raise quietly disappears into a slightly bigger checking account balance. It's not a $500 decision. It's a 6-figure decision, hiding inside an ordinary paycheck.
Waiting for someone to notice it before it gets spent on something they won't remember by next year.